Opposing Viewpoints series, Chapter 4, Book 4, What Makes Some Investments Illegal. I'm going to read the preface. An investment is never certain. It runs the risk of losing value, but tantalizes with the promise of growing in value instead. Some investments, however, are considered by the law to be illegal, which is where viewpoints in this chapter converge. The Ponzi scheme is considered the classic form of this kind of theft, in which investors discover they are not putting their money into a business, but are instead paying older investors to make it seem like they're making a profit and encourage more investors to join. When the scheme is outed, the business is revealed to have been a mirage. Charles Ponzi, for instance, has told investors that the dip in currency exchange rates in Europe after World War I meant the postage coupons could be bought cheaply there and then resold in the U.S. for more money. Bernie Madoff told investors that he had invented the idea of split strike conversion, which involved buying and selling stocks from the S&P 100 at opportunistic times that would evade downswings in the market. In reality, these proved to be fictional sales that never happened. Instead, Madoff used the money clients invested to pay clients who wanted to cash out their investments. The nature of investment scams is ever changing and has grown to include cryptocurrencies, where they're often buying non-fungible tokens, NFTs. Since NFTs and cryptocurrencies have no inherent value, they can be easily manipulated for scams. Insider trading is a trickier form of investment crime. The inside trader is deliberately buying and selling stocks in advance of their increase or decrease in value based on information that will impact their price but hasn't been made public yet. Because it is dependent on having access to information about the inner workings of the company or industry, its perpetrators can often include prominent and powerful figures like businesswomen and media personality Martha Stewart or Chris Collins, a former congressman of New York. The viewpoints in this chapter investigate the ways that these investment-related crimes take place and ways they are policed. They also consider the larger corporations and legal culture that forms around the investment scams and crimes. I believe that we can skip the next viewpoint because it's about the infamous case of Bernie Madoff, which has been reviewed extensively in other sources. Madoff's apparently ultra-high returns persuaded clients to look the other way. It talks about his early life and education, noble accomplishments, the scandal, scheme, and crime, the parties involved, the scheme, the investigation. It could be worthwhile to say that here the SEC was investigating him per a whistleblower, SEC complaints, and what's this mosaic theory? Marco Polo's, who was the whistleblower, noted several irregularities. Madoff's firm claimed to be making money even when the S&P was falling, and which made no mathematical sense based on what Madoff claimed he was investing in. The biggest red flag of all, in Marco Polo's words, was that Madoff securities were earning undisclosed commissions instead of the standard hedge fund fee of 1% of the total plus 20% of the profits. And the bottom line was the investors that pony up the money didn't know that Bernie Madoff is managing their money. They learned Madoff was applying for huge loans at European banks, seemingly unnecessary if Madoff's returns were so high. Okay, so one form of identifying just benchmarking individual investment to market rate of return, and the punishment. Other books written about this: The Wizard of Lies, Bernie Madoff, and the Death of Trust. Okay, so his 3 homes and 4 boats were auctioned off by the U.S. Marshals. And an aftermath, a Madoff victim fund, $14 billion involved in this. who started the Ponzi scheme, and this one's about, we were just talking about Charles Ponzi, the scam was earning him $250,000 a day, which is crazy considering when it happened. Okay, who was Bernie Madoff? Depictions of Bernie Madoff in the popular culture. They're talking about HBO's Curb Your Enthusiasm, Investing with Madoff, The View of Penthouse B, Blue Jasmine is Woody Allen's film. Okay, so this goes on and on. How much money did Bernie Madoff return? 170 billion, which is weird because I thought it was only 14 billion. The victim fund says something here about 4 billion. Okay, so how did we go from 4 to 170 billion? His assets included real estate, yachts, jewelry, seized from the feds, blah. And what was recovered was 4.7 billion, close to 40,000 victims as of September 2021. How did he get caught? Looks like admissions to his sons who turned him over to the authorities. And the bottom line is at 71, he pled guilty to 11 federal counts, including securities fraud, wire fraud, mail fraud, perjury, and money laundering. The Ponzi scheme became a potent symbol of the culture of greed and dishonesty that, to critics, pervaded Wall Street in the run-up to the financial crisis. Madoff, the subject of numerous articles, books, movies, and biopic miniseries, was sentenced to 150 years in prison in order to forfeit 170 billion in assets, but no other prominent Wall Street figures faced legal ramifications in the wake of the crisis. And he died in jail at 82, but it looks like that's 11 years of prosecution going on. What is insider trading? I wanted to read Viewpoint 2 in its entirety. And not all trading by insiders, and it is insider trading. And Viewpoint 4, are cryptocurrencies a scam? And skipping the risks of investing in art. Oh, maybe not skipping that. So, but how to avoid investment scams. Rather than skip it, I'm just going to list a couple from the SEC's Office of Investor in Education and Advocacy, OIEA, and Retail Strategy Task Force. Say, check the background of anyone selling or offering you an investment and confirm that the person is currently registered or licensed. Look out for common tricks that con artists use to attract investors. Get rich quickly and easily. Urgency. Interestingly, I've got some case names here. So I will read the brief. There's the SEC versus Senderov and Babazara. The SEC took action against a fraudulent multi-million-dollar scheme that used boiler room-like call centers to solicit investors. The SEC alleges that the call center's employees had a business practice of promising investors that the investments offered. So this is over-promising. That the investments offered would be highly profitable. Examples of these promises allegedly include employees telling investors, we will watch your money double in 30 days, and if you deposit 30 to 40, you can exact product 10% a month. The goal is for your investments to earn 7% per month. According to SEC's complaint, many investors lost a significant portion of the money they invested. Urgency, if I didn't already say it, and then this other SEC case versus Peterson that I'm briefing. The SEC brought charges against the owners and operators of several boiler room-like call centers for defrauding investors. The SEC's complaint alleges the call center employees passed off themselves as brokers. Okay, so posturing as brokers. So, and financial advisors, despite having little or no relevant experience, brokers and financial advisors allegedly try to trick investors into making additional and often large deposits, creating a false sense of urgency. The SEC alleges the defendant's training materials stated that you need to create urgency at the beginning of the call, define urgency as like tomorrow, high pressure sales tactics, included citing upcoming earnings announcements by well-known public companies, expected public disclosures, and fake testimonials are your red flags. So I'm going to go back to what is insider trading. Quoting here from Viewpoint 2, regardless of the stance individuals take, insider trading is currently illegal and can be severely punished through fines and time in prison. This piece is written by Andrew Sebastian about another type of crime in the world of financial investment is insider trading, which deals with utilizing non-public information in order to determine the best time to buy and sell investments. In this viewpoint, Andrew Sebastian looks at some of the arguments for why insider trading doesn't harm as many people as the law presumes it does. After all, most non-public information becomes public at some point. Perhaps because of the ease of committing insider trading, it remains one of the more common forms of white-collar crime. Sebastian is a writer in Investopedia with a background in advising in investment strategies. So that is a really basic definition of insider trading. It's much more expansive. Like, for instance, Rule 10b-5 prohibits most instances of trading securities on the basis of inside information, that is, information not disclosed to the public that an investor would think is important when deciding whether or not to invest in a security. There's 4 subparts. A person violates Rule 10b-5 if by trading he breaches a duty of trust and confidence owed to the issuer, shareholders of the issuer, or 3, in the case of misappropriators, another person who is the source of material non-public information. 2, anyone who breaches a duty not to use inside information for personal benefit can be held liable under Rule 10b-5. If an insider gives a tip of inside information to someone else who trades on the basis of inside information, the tipper can be liable under Rule 10b-5 even though they didn't actually trade. And if the tip was made for improper purpose, such as exchange for money or a kickback or a gift or a reputational benefit, etc., a tipee can be held liable only if the tipper breached a duty and the tipee knew the tipper was breaching the duty. Other interesting forms, this comes in so many different shapes and forms, but Section 16B of, I'm going to say these are SEC laws, requires the surrender of a corporation of any profit realized by any director, officer, or shareholder owning more than 10% of a class of a corporation stock from the purchase or sale and purchase of any equity security within a 6-month period, according to either the sale or purchase test, which is the type of sale in which abuse of inside information is likely to occur. Transactions occurring before one becomes an officer or director are excluded, but transactions occurring within 6 months after ceasing to be an officer or director can be uncovered. And it applies to publicly held corporations with more than or 10 million in assets, or 2,000 or more shareholders, or 500 shareholders who are not accredited investors in any outstanding class, or those shares that are public traded in national exchange. So I meant to say privately traded in the first 2 parts of the 10 billion assets, 2,000 shareholders or 500 not accredited shareholders, and or those that are publicly traded. And profit is determined by matching the highest sales price against the lowest purchase price for any 6-month period. And this is a strict liability, which means that finding of the profit, gain or avoided loss of the value set by the rule is automatically a crime, or automatically got to be disgorged if the elements are met. A debate rages on in the financial community among professionals and academics about whether insider trading is good or bad for markets. Insider trading refers to the purchase or sale of securities by someone with information that is material and not in the public realm. Insider trading is not limited to company management directors or employees. Outside investors, brokers, and fund managers can also violate insider trading laws if they gain access to non-public information. Arguments for insider trading. One argument in favor of insider trading is that it allows non-public information to be reflected in the securities price and not just public information. Critics of insider trading claim that it would make markets more efficient. As insiders and others with non-public information buy or sell the shares of a company, for example, the direction and price conveys information to other investors. Current investors can buy or sell on the price movements, and prospective investors can do the same. Prospective investors could buy at better prices, while current ones could sell at better prices. Delaying the inevitable ? Another argument in favor of insider trading is that barring the practice only delays the inevitable and leads to investor errors. A securities price will rise or fall based on material information. Suppose an insider has good news about a company but cannot buy its stock. Then those who sell in the time between when the insider knows the information and when it becomes public are prevented from seeing a price increase. Barring investors from readily receiving information or getting that information indirectly through price movements can lead to errors. They might buy or sell a stock that they otherwise would not have traded if the information had been available earlier. Laws against insider trading, especially when vigorously enforced, can result in innocent people going to prison. As rules became more complex, it becomes harder to know what is or is not legal, resulting in participants accidentally breaking the law without knowing so. For example, someone with access to material non-public information might accidentally disclose it to the visiting relative while talking over the phone. If the relative accidentally information gets caught, the person who accidentally disclosed it might also go to prison. These sorts of risks increase fear to the point where talented people pursue careers elsewhere. Warning: if you happen to get material non-public information, do not make an investment decision based on it until that information becomes public. Also, never share material non-public information with outsiders. Yet another argument for allowing insider trading is that it is not serious enough to be worth prosecuting. The government must spend its limited resources on catching non-violent traders to enforce laws against insider trading. There's an opportunity cost to going after insider trading because the government must divert those resources from cases of outright theft, violent assault, or even murder. Arguments against insider trading. One argument against insider trading is that if a select few people trade on material non-public information, then the public might perceive markets as unfair. That could undermine confidence in the financial system, and retail investors will not want to participate in rigged markets. Insiders with non-public information would be able to avoid losses and benefit from gains. That effectively eliminates the inherent risk that investors without the undisclosed information take on by investing. As the public gives up on markets, firms would have more difficulty raising funds. Capital. Eventually, there might be few outsiders left. At that point, insider trading could eliminate itself. Investors without non-public information. Another argument against insider trading is that it robs the investors without non-public information of receiving the full value for their securities. If non-public information became widely known before the insider trading occurred, the markets would integrate that information, resulting in accurately priced securities. Suppose a pharmaceutical company has success on phase 3 trials for a new vaccine and will make that information public in a week. Then there is an opportunity for an investor with that non-public information to exploit it. Such an investor could purchase the pharmaceutical company's stock before the public release of the information. The investor could significantly benefit from the rise in the price after the news is made public by buying call options. The investor who sold the options without knowledge of the success of the phase 3 trials probably would not have done so with full information. The legality of insider trading. Certain types of insider trading have become illegal through court interpretations of other laws, such as the SEC Act of 1934. Insider trading by a company's directors can be legal as long as they disclose their buying and selling activity to the Securities and Exchange Commission, and that information subsequently becomes public. For many years, insider trading laws did not apply to members of Congress. Some lawmakers sought to profit from material non-public information during the 2008 financial crisis. Bringing the issue to the public's attention, Congress overwhelmingly passed the Stock Act to remedy this situation. And President Barack Obama signed it into law in 2012. Example of insider trading. An example of insider trading involves Michael Milken, known as the junk bond king throughout the 1980s. Milken was famous for trading junk bonds and helped develop the market for below investment grade debt during the tenure at the now defunct investment bank Drexel Burnham Ham Lambert. Malkin was accused of using non-public information related to junk bond deals that were being orchestrated by investors and companies to take over other companies. He was charged with using such information to purchase stock in the takeover targets and benefiting from the rise of the stock prices on the takeover announcements. Suppose the investor selling the stock to Malkin had known the bond deals were being arranged to finance the purchase of those companies. There's a good chance that it would have held onto the shares to gain from the appreciation. Instead, the information was non-public, and only people in Malkin's position could benefit. Malkin eventually pled guilty to securities fraud, paid a $600 million fine, was banned from the securities industry for life, and served 2 years in prison. The bottom line is that insider trading has both proponents and critics. Those against insider trading believe that it tips the balance in favor of those with non-public information. Advocates of insider trading believe that it avoids risks and makes markets more efficient. Regardless of the stance individuals take, insider trading is currently illegal and can be severely punished through fines and time in prison. Not all trading by insiders is insider trading, is Viewpoint 3 from Financial Spread Betting. What could be more immoral than someone selling or buying stock on the basis of information he knows the other party lacks? And we go into Martha Stewart. She was only in jail for 5 months. I wonder what payback is. Payback sounds like a inside knowledge of specifics and earnings report, a pending merger, a legal basis for stock market insider trading, more general inside knowledge is not. Okay, I don't know if that's a publication, but markets and prices is the main next subsection. Who's the victim? Either specific buyers or sellers of stock shares who did not possess the inside information in the market. Confidence is so we're kind of going back and forth on opinions here. Is it right or wrong? Right? Some are of the opinion that prices reflect up-to-date information. Calling this like the price system. What is the price system? Is that what that means? Prices reflect up-to-date information. Explain this as the price system does more than tell us what we must pay for goods and services. It produces information, a highly concentrated economic form about supply and demand. That's the price system. So Martha Stewart's case in stock insider trading, I'm clone stock sale. She knew something from the Food and Drug.
You don't know how she found out about it.
For the anti-cancer drug Erbitux. Yeah, they were going to deny M-clone. So the FDA was going to deny M-clone anti-cancer drug Erbitux. So she probably avoided the loss, if I remember correctly. I'm just trying to, she was short selling while it was trialing in Europe, this Erbitux cancer drug. And on the day she sold 7.7 million IM clone shares were traded 5 times the value of the day before. The members of then CEO Sam Waksell's family, who were also tipped off early about the FDI sold only 150,000 shares. Maybe the knowledge wasn't so inside after all. And that's about all there really is to say about Martha Stewart. Doesn't really give. I mean, there's some discussion here of civil lawsuits. There's a reference to the Insider Trading and Stock Market book by Henry Main, saying the long-term trend of stock prices is upward, so that all other things being equal, occasions for good news should exceed those of bad, and any undeserved risks to investors resulting from insider trading must therefore constitute a very small fraction of the total risk assumed by long-term investors. Yeah, it's a bunch of shared risk. Okay, so anyhow, moving on to Are Cryptocurrencies a Scam? This is Viewpoint 4, beginning with a quote. Some say there's a Wild West vibe to crypto culture and the element of mystery too. The Viewpoint by Emma Fletcher takes a look at how scammers have used popular interest in cryptocurrencies to create new ways of defrauding investors. According to the Federal Trade Commission, a U.S. government agency that regulates trade, at one point investment scams had topped the list as the most lucrative ways to obtain cryptocurrency. But often times, investors will discover that they've sent the cryptocurrency they bought directly into a scammer's wallet. In recent years, the number of cryptocurrency investment scams that have been reported have increased exponentially. And Emma Fletcher is a senior data researcher at the FTC. As you read, consider the following questions. How does this viewpoint say that scammers are taking advantage of the hype around cryptocurrencies? What are some of the scams that the viewpoint identifies, and who do these scams target? Investing in cryptocurrencies means taking on risk, but getting scammed shouldn't be one of them. Reports to the FTC's Consumer Centennial suggest scammers are cashing in on the buzz around cryptocurrency and luring people into bogus investment opportunities in record numbers. Since October 2020, reports have skyrocketed, with nearly 7,000 people reporting losses of more than $80 million on these scams. The reported median loss, $1,900. Compared to the same period a year earlier, that's about 12 times the number of reports and nearly 1,000 more in reported losses. Some say there's a Wild West vibe to the crypto culture and an element of mystery too. Cryptocurrency enthusiasts congregate online to chat about their shared passion, and with Bitcoin's value soaring in recent months, new investors may be eager to get in on the action. All of this plays right into the hands of scammers. They blend into the scene with claims that can seem plausible because cryptocurrency is unknown territory for many people. Online, people may appear to be friendly and willing to share their tips, but that can also be part of a ruse to get people to invest in their scheme. In fact, some of these schemes are based on referral chains and work by bringing in people who then recruit new investors. Many people have reported being lured to websites that look like opportunities for investing in or mining cryptocurrencies, but are bogus. They often offer several investment tiers. The more you put in, the bigger the supposed return. Sites use fake testimonials and cryptocurrency jargon to appear credible, but promises of enormous guaranteed returns are simply lies. These websites may even make it look like your investment is growing, but people report that when they try to withdraw supposed profits, they are told to send even more crypto and end up getting nothing back. Then there are giveaway scams supposedly sponsored by celebrities or other known figures in the cryptocurrency space that promise to that's the offboarding, the off-ramp of getting funds out of digital form. Other known figures in the cryptography, and I think that's where most of the prosecution, or that's where most of the control is. So designing controls to prevent offboarding or to identify the source of funds at offboarding is where you're going to find the most litigation or opportunity for litigation. So then there are giveaway scams we talked about. People report that they discovered later that they simply sent their crypto directly to the scammer's wallet. For example, people have reported sending more than $2 million in cryptocurrency to Elon Musk impersonators over the past 6 months. Scammers even use online dating to draw people into cryptocurrency investment scams. Many people have reported believing they were in long-distance relationship when their new love started chatting about a hot cryptocurrency opportunity, which they then acted on. About 20% of the people reported losing through romance scams since October 2020 was then cryptocurrency, and many of these reports were from people who said they thought they were investing. Okay, since October 2020, people ages 20 to 49 were over 5 times more likely to report losing money on cryptocurrency investment scams than older age groups. The numbers are specifically striking for people in their 20s and 30s. This group reported losing far more money on investment scams than any other type of fraud, and more than half of the reported investment scam losses were in cryptocurrency. In contrast, people 50 and older were far less likely to report losing money in cryptocurrency investment scams, but when those gossips did lose money on these scams, the reported individual losses were higher, with a median reported loss of $3,250. To be clear, when investment scams top the list as the most lucrative way to obtain cryptocurrency, scammers will use whatever story works to get people to send crypto. That often involves impersonating a government authority or a well-known business. For example, many people have told the FTC they loaded cash into Bitcoin ATM machines to pay imposters claiming to be from the Social Security Administration. Others reported losing money to scammers posing as Coinbase, a well-known cryptocurrency exchange. In fact, 14% of reported losses to imposters of all types are now in cryptocurrency. Here are some things to know to play it safe or safer when it comes to cryptocurrency. Promises of guaranteed future returns or claims that your cryptocurrency will be multiplied are always scams. The cryptocurrency itself is an investment. You make money if you're lucky enough to sell it for more than you paid. Period. Don't trust people who say they know a better way. If a caller, love interest organization, or anyone else insists on cryptocurrency, you can bet it's a scam. To learn more about cryptocurrency scams, visit ftc.gov/cryptocurrency. You can spot a scam, report to the FTC at reportfraudftc.gov. And that's the end of what is being read in the opposing Viewpoints white collar crime text.